Welcome to Dollars and Cents. We're gonna hopefully try and make some sense out of this past week's headlines. Boy, what a week it was. Certainly, Russia's invasion of Ukraine is on everybody's mind this morning and how all of that plays out for the future. So we'll try and make sense of that on the program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. So we want to start off the program with just some thoughts, if you will, on those headline events that certainly shook the world this past week. And it's interesting because at the age that I am at, I'm 51, I grew up in that time where the Cold War was still with us but was transitioning away from that. So most of my adult life, if not all of it, I suppose, has been in this sort of post-Cold World era where the focus of countries has been on the economy and economic globalization and all countries sort of becoming wealthier, if you will, through this notion of being able to sell one's products pretty much in any place on the planet. And certainly that period of time brought a lot of stability, brought a lot of wealth, not just to the US, but across the globe. If you look at the percentage of the population is living in poverty today globally versus where it was 40 years ago, you can certainly attribute those improvements to humankind as a result of this sort of global economic approach that the world's countries have had in sort of this post-Cold War area. But I suppose 40 years of post-Cold War global economic activity has caused us to sort of forget a couple of things along the way that perhaps this past week's headlines served as a stark reminder. First and foremost, not everybody wants the same thing. I think it's very clear that Russian leadership, particularly the individual known as Vladimir Putin, wants the old Russia. I think that's pretty clear in some of the speeches that he made. And, I guess understandably, that sort of makes sense when you consider that Russia itself no longer a superpower, right? I mean, the economic, and was one of the kind of the statistics that I was sharing this past week with the clients that we were visiting with. The size of the Russian economy is equal to about half the size of the economy of the state of California. Now that should strike you as saying, well, wait a minute, that's not a very big economic power, if you will. And in the pecking order of things, if you're measuring GDP, yeah, that's not a big power. Now, they've got some stuff that the world uses and still relies on very heavily in the form of oil and natural gas. And so anytime you can have those prices increase, well, then certainly that goes directly to your economic benefit. But the reality is, when you think of it, it's almost a third world kind of country in terms of the size of the economy. And certainly, when we talk about wealth disparity, wealth discrepancy, perhaps Russia gives a little perspective. You hear a lot of that conversation about the wealth disparity in this country. And the reality is, I think a lot of those statistics don't include the amount of government payments, nor do they sort of net out the tax load of those that are higher income. But again, that's a little bit of a digression. Anyway, the reality is that if you want a classic example of wealth disparity, look no further than what is happening in Russia and what's been happening in Russia over the course of the past couple of decades. So dramatic sort of a return, if you will. They would like a return, very clear, and he said it as much in his speech this past week, a return to the Cold War era power, economic might, superpower, but that's gotten forgotten sort of along the way. That, again, clearly, not everybody wants the same thing. And certainly the leadership of Russia would be a perfect example of that. And we have to recognize that. We can't just assume that. And I guess that gets to the second thought that I had as things were playing out this week. And that is, you have to still be afraid of the bully in the sandbox. And we talk a lot about nowadays, we think that if we just talk calmly to that bully or we treat him nicely, eventually he'll come around. If we maybe put him through some programming and again, just talk to him nicely, point out the pros and the cons, he'll come around. I think this is a stark reminder that's not how many in the world, particularly when you are in charge of a country that you want different things than what everybody else wants, then there's not a lot of reasoning that you can put to that equation. And the reality is that that's premise. If you assume that you're going to be able to talk to the bully, then perhaps that premise isn't valid in the first place. And certainly our foreign policy over the course of the past 40 odd years would suggest that. Wall Street Journal had a fascinating article in it on this weekend, in the weekend edition, that had all of these pictures of every president going back for the past 30 years, sitting down with this guy, thinking that they're going to talk it out and all those kinds of things. The reality is it doesn't work. There are real enemies out there who would seek to destroy and to do harm to this country. So better start addressing the reality and perhaps not worry quite so much about the things that we worry about here in this country. I'll let you come up with your own list of things that perhaps we're worrying about these days, that in the grand perspective of the global stage, this might give some perspective. Anyway, clearly the market had a lot to say about this past week, but in the end, what was crazy about all of that is with the 4-day market week, because of course Monday the markets were closed because of President's Day, markets were actually up. S&P 500 was up almost 1% for the year. NASDAQ was, for the week, NASDAQ was up 1%. The Dow basically flat. How on earth did the markets respond that way? Now, it certainly wasn't a smooth path. If you were watching the markets on Thursday, you saw them drop 3.4%, only to wind up with a gain of 3.5%, almost a full 7-point swing in the market on Thursday. That's only the 16th time in the past 15 years where the markets have ended positively after being down at least 2.5% earlier in the day. That's the definition of volatility. We're going to talk more about sort of how that week played out and how on earth that happened after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the week that was certainly a very strange week for the markets at the end, given the headlines involving Russia and Ukraine. The markets, in fact, wound up being positive for the week. Overall, S&P 500 slightly up, slightly less than 1%. So welcome to Dollars and Cents, where we're helping folks hopefully make some sense of the week that was, particularly after you have such dramatic headlines like Russia's invasion of Ukraine. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So talking particularly before the break about Thursday, particularly that big swing. At one point the markets were down 3.4% and only to wind up for the day 3.5%. So a 7 percentage point swing. Folks, that's the very definition of volatility. Remember, volatility can go both ways, both up and down, right? Volatility is movement up and down. And so sometimes I think when we think about the markets, we only think about that down part. Certainly there was an up part, particularly to what happened this past week. So how on earth did that happen? How did we go? Because Thursday was when the tanks were literally rolling in to the capital city of Ukraine, despite Putin's statements over the past weeks, months, years that, oh, I'm not going to do that. So how did that market wind up sort of staging that big of a reversal? Well, it seems that there were two things afoot, and I think they bear discussion on the program. First of all, the data suggests that a lot of that shift in market sentiment was actually caused by retail investors. So give yourselves a hand, because retail investors are those folks, normal people, who are putting money into investment. So that certainly helped to change and reverse sort of the pattern. When you look at the data on Thursday alone, investors were there to sort of prop up the markets. Total net inflow of about 1.5 billion in US listed stocks and ETFs. That was the most in a couple of weeks. In essence, the individual investors were buying on the dips, right? Market dips down. That's an opportunity to invest when things are on sale. So certainly not a bad thought if you think about the markets from where they were at the beginning of the year to where they are, where they wound up this past week. So we're in that 10% correction sort of territory. So, all right, maybe that helps to explain a little bit what was going on Thursday. Similarly, let's not forget, though, the economic issues that have sort of slid to the back of the paper this past week, but they are very significant. The inflation reading that came out this past week, north of 6%, and certainly the specter of higher interest rates, those still have an impact. And I think this past week there was maybe some thought that because of these headlines and how dramatic these headline events can be, that perhaps that interest rate increase that is on tap for March, coming right up in about 3 or 4 weeks, might not be a half a point. It may only be a quarter point. So maybe these events in Ukraine suggest that we'll see the Federal Reserve sort of raise rates at a little bit sort of slower pace, if you will. So that in and of itself would cause interest rates and money costs to be lower for perhaps longer. And so perhaps that was also at play in the overall market. So in essence, sort of that slower pace of interest rates may have also contributed to that. Again, though, bigger issue in terms of longer term impacts in the economy, inflation, interest rates. We think it's more important to sort of watch those more than anything else. The market has a tendency on these headline events to be relatively short-lived in terms of its reaction. We think back to 9/11, or we think back to the Iraq invasion of Kuwait. It didn't take a lot of days before the markets recovered to those pre-invasion dates. When Iraq invaded Kuwait, it was 189 days before the markets recovered to that that level that they were before that invasion. Now, obviously, this is a little different because in Kuwait we got involved, and I don't know that we're going to get involved on the ground like we did in that situation. But again, when you go back through history and see kind of these headline events, the market has a tendency to respond very quickly, but also recover very quickly. So the point there is it's not necessarily about the headline event. It's really more always about those real economic issues. And so for us, it still means inflation, interest rates, those become the more important pieces of the equation. Regardless, anytime you run into these types of headlines, there's always some things or some truths that investors should keep in mind. And so we want to recap those three. First, and this one shouldn't really surprise you, but you can't predict the future. As much as you think you might be able to see how this all plays out, you're not going to be able to predict it with any degree of accuracy. As much as you think that, oil's going to do this, or oil's going to do that, or consumer goods sector is going to do this or that, you're not going to really be able to predict that with any degree of accuracy. So bottom line then, if you're an investor, you should be diversified. That eliminates guessing where things are going to go, because if you're diversified, then you have different things. And if you own different things in your investment portfolio, then they're going to do different things at different times and produce different results. That's the nature of diversification. So maybe you've got something in your portfolio that has gone down a lot. If we think of what's gone on so far this year, large tech growth companies have certainly gone down a lot, but meanwhile, dividend paying companies haven't. Again, the underscore of why you are diversified. Different things doing different results at different times in your portfolio. Number two, now is kind of a bad time to really make big changes to the portfolio. Why? Because chances are those changes that you're going to be making are going to be dictated by the very powerful emotion known as fear. Fear will cause you to overreact, to overcorrect. Frankly, you want to reposition things when the world is in more of a calm state. That's why all throughout last year, even though the markets were continuing to go up and up and up and up and up, we were talking at length on this program and with our clients the notion of rebalancing, taking some profit, particularly off those large tech category companies, and rebalance the portfolio when times are normal. So, in other words, review the portfolio allocation, and do that when things are calm. Rebalance on a regular basis will allow you to sort of avoid overreacting when things aren't so calm, because you certainly don't want to do that in a panic. And then lastly, consider embracing the surprise instead of fleeing from it. Well, what are we talking about there? Well, the reality is that these headline events provide an opportunity for folks, if they're maybe sitting in cash, or maybe they were heavy on the bond side, they were looking for opportunities to sort of get out of that bond, get out of that cash, or not get out of it altogether, of course, but perhaps reduce it. This certainly presents an opportunity for investors to do just that. So certainly an important opportunity to sort of look at and say, okay, if I've got money, if I've got cash, then now is a good time to maybe start some kind of a dollar cost averaging type of an approach where I'm putting money in on a regular basis. That certainly helps to smooth out volatile times like this. So those are the three takeaways for investors to be thinking about. We're going to go to a break. When we return, we'll continue the conversation here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.